Hello and welcome to Smart Money. It's a special episode on Smart Money today. We interview another outstanding woman in finance as part of our special initiative, Future Female Forward. On my show today is Ayshwarya Desikan, who is the Director and Head South India Wealth and Personal Banking at HSBC India. Now, Ayshwarya has a rich experience of over 2 decades with HSBC. She has worked across functions including trade finance, cash management, retail banking, NRI services, private banking and wealth management. She currently is Director and Head of South India for Wealth and Personal Banking at HSBC. And along with managing all of this, she also juggles motherhood and is a mom of 2. Today, we'll speak to Ayshwarya about her 2-decade-long financial journey. And the topic that we've picked up today is 5 biggest financial lessons that she has to offer to our viewers. Ayshwarya, thanks a lot for joining in, and it's a pleasure having you on the show. You know, the first thing that I want to talk to you about, of course, is this whole argument about how it's hard for women to survive in a very competitive environment, especially like the world of finance. Has it been about gender for you at all, or has it been smooth sailing?
First and foremost, Sonia, thank you for having me, and it's a pleasure being here. And I would like to say that, yes, there are ups and downs in everyone's careers, and as a woman, especially, there are life cycles that we go through, right, to children, and obviously there are those breaks that you do take. I guess finally it works down to 2 things. One, how your organization supports you in terms of having policies which ensure that these breaks don't derail you, but actually are supportive for you to take off where you left. And number 2 is also, finally, it's about what we bring on the table, how much responsibility we own up. So I guess it's a combination of both. I wouldn't really say that I suffered it so much, but over years, I've always definitely seen that the policies have been getting better and even better.
So you have 2 children, right? I don't know how you do it, because with one child I find it very hard to manage. But what's the biggest hack, the parenting hack that you've been able to figure out, which has helped you balance both?
So I think the younger one, is the one which has really seen the brunt of it a lot these days. But my elder one is another parent to her. So, somewhere I think my son kind of also becomes the 3 of us literally handling the child. But again, finally, I think it comes down to the balance, right? Making that quality time when you can. With the kind of jobs that we do, there is travel, there is pressure on the family.
Absolutely.
But when everyone is in it together and there is communication, I think people just understand, and finally it works.
I like that. You've made your older one the parent to the younger one.
It was not intentional, but it so happened and it's working. So I'm really grateful for that.
Okay, whatever works, right? So we're here to talk about the 5 investment mantra, so to speak, that you have learned in your 2-decade-long career now. The first one you talk about is arbitrage. Now tell us, what does this mean and what should our viewers take away from this?
So I always feel that at any point in time, there is an opportunity of where you want to deploy your capital or where it best serves you. And many times, because traditionally we've been told that don't keep a debt, pay off your home loan, all of us are battling with, should I prepay my debt or should I really invest in the market? Now, if someone like me who is open to investing in the capital market, right, if you look at a 10-year home loan that you typically tend to hold, the interest rate trends have been between 6.5% to 9% at best at the most costliest. And your 10-year CAGR on the market, Nifty, has been about close to 12%. So there's clearly between 3.5% to 5% arbitrage opportunity which is available. And that is the rate at which your portfolio is compounding if you choose to invest your capital rather than prepaying your loan. So I think this is a conscious call that we need to evaluate from time to time. It might suit people where you are open to investing in the market. It might not suit if someone is very conservative and wants to do a deposit or something else. So I guess that is what I mean by arbitrage, understanding where does your capital best serve you and taking a conscious call, depending on your time frame, depending on your risk, always helps in making that smart move in terms of accumulating much more.
So what is your advice to people, because we get a lot of young investors who watch our show. So if someone has perhaps taken a loan and also wants to grow their corpus, right, eventually meet all their financial goals, what is your advice? How should one go about it? Is taking a loan worth it, prepaying your loan, or rather investing that money in the equity markets and then paying over time? What's the best way to do it?
So 2 things, right? We should never confuse leverage and arbitrage. Because if someone is overly leveraged and wanting to invest in the market, it becomes a punt at some point. And if you're really not watching it, that's when things go really wrong. Second thing is, on the debt, again, it is okay to use your cards. It's okay to flex your cards, really, because the kind of benefits today that credit cards offer, right, in terms of free miles, hotel vouchers, travel vouchers, amazing kind of benefits that you get. But at the same time, it also does charge you a 3% monthly. So it is important to use that 45-day free credit that you get, but at the same time ensure you clear the debt, because no other investment is going to give you that kind of an yield going. So it is important. That's why at every decision that you make, what are the options which are available, and evaluate.
Okay, guys, so evaluate your decision. Don't just make any decision impulsively, right? That's the meaning of arbitrage. Okay, let's move on to lesson number 2. How to choose an investment option. Now, this is tricky, right? Because like you said, we go through so many phases in life. As a woman, we not only have our children, we have their education, their marriage. And, you know, during retirement, a study shows that women are sort of not as financially equipped to deal with their retirement as men are, perhaps, because they're so busy using their funds to raise their children or their family. So how to choose an investment option?
So 2-3 things which I have also learned by experience. First and foremost is, when we first choose our investment option, we go by information available around us. What are our friends investing into? What is family talking about? Now, no one size fits all, and people could come from different risk appetites, different cash flows, and hence something which works for someone else might not work for you. Number 2 is to understand what your short-term, long-term goals are. So like you said, that what are your larger goals and corpuses that you're planning towards? And for that, what is the best, what is your risk appetite, number 2? And accordingly, allocate your investments towards that. I guess that is the best way to do it, rather than just following trends. Because even if you go by information available in the market, right, the best ratings that is available always talks about past performance. And that might or might not work for future, because in certain cases it does indicate track record. But if you're not aware of the fundamentals, you might end up choosing probably a sectoral fund after that sector has run up. Or you might end up choosing something like a debt, for example, when it's done very, very well, which means that you're on the declining interest rate cycle. So probably for you, you might end up with a negative return if you choose it, you know, by looking at
the wrong time.
At the wrong time. So understanding what that investment is and spending that time, and the question on women that you were asking, right? A lot of times, and I've seen a lot of articles which also talk about that women don't really take that time to plan their finances. I hope it is getting better, and I hear it is getting better. I think financially being independent is very, very important for women, which includes taking your own financial decisions. And you have to do it, and the more you start doing it is when you learn from it.
The earlier you start doing it. What has your own personal experience been? For someone who's been in the banking industry for 2 decades, I assume you've built a decent corpus for yourself. Maybe the power of compounding has helped you, but you know, reality may be otherwise. You tell us, what has your experience been?
So it has been everything, right? Because when I started my career, like you just saw, I was not in the financial side or wealth management side of it. So I've actually been in operation. And hence I've actually gone and done all these mistakes myself. In terms of, you know, everyone is telling me to buy this and let me buy this, or clients are buying this and let me buy this. And then over time,
so what was your biggest investing mistake? Something that you tell everyone to avoid?
One, I would say, is don't choose only by a rating calendar. And, you know, that is the super important one, because most times, like, we've had people who come and tell us that you've given me a diversified portfolio of 10 funds. This one gave like a superlative return. Why don't I just move everything else into that? That's the biggest mistake that you can make, right? But it's very tempting to do that, especially with so much of information around you and overload of information around you. So I think that is the biggest one, which I will say, that do not get carried away by the noise. Do not get carried away by so much of information overload. And
don't get carried away by past returns, because the future may not be the same. Okay, so those are 2 lessons. The third lesson is be disciplined. This is easier said than done, right? Because of course our SIPs keep going monthly and all of that, but real discipline comes in when the markets sort of take a turn for the worse, right? So when you say be disciplined, what do you mean?
So there are 2 components of be disciplined. One, like the point that you were talking about, let me pick that first, right? If you are not booking your profit or cutting your losses at the right time, you might really end up losing money on the portfolio. Now, let's take an example, right? February 24th, when you had the Russia-Ukraine war and Nifty corrected 5%. If someone was sitting on cash and they could have easily deployed it without looking at the sentimental and the noise around it, but just to say that there is an opportunity. But did you take that call is really what matters. Now, when you're disciplined, what happens that you say that at every 10% beyond a particular valuation where you're comfortable, right? Be it buy or sell. Let me sell at every 10% raise beyond this because this is where I think it is break even, where it's getting expensive. Similarly, when it is really falling and you find that opportunity, if there is a long-term potential, right, and it's available at a price that is reasonable for you, then should I start buying? So at every 10% fall, can I invest 10% of my portfolio? So that amount of discipline or having those guardrails for yourself, I guess, becomes very important.
Okay.
Number two, I will say is also be disciplined about reviewing your portfolio.
Okay.
Sometimes we just completely ignore and forget about it for years. And reviewing does not necessarily mean action.
Yeah.
Inaction is equally okay. But at least understanding what was your goal, is your portfolio in line to your goal? And is there any fundamental change or an error that you need to correct from time to time is something that is important to keep looking at.
Okay, I have a question here. For people who perhaps are not that savvy in the market, right? But they still know by and large what are passive funds, what are active funds. Do you think a money manager is needed, or can you do a lot of the corpus building on your own?
I always feel a money manager is very needed, right? In fact, that is one of the biggest decisions that I think I will really say. People today shy away from paying the price for a money manager because there is so much information, and you keep saying that there is information available, let me take the call myself, I know about the markets. Now, tell me one thing, right? If you have a medical ailment, you might Google it, but can you do a surgery on yourself?
No.
Right? So it is important that the information is there. You read up, you understand, which will help you take an informed decision. You don't get carried away by what someone is telling you. But at the same time, these are experts in the market. They are tracking it day in, day out. Number two is...
They're also buying and selling at the right time, which you may not be able to do.
Exactly.
So they're doing it for you in your fund.
Especially fund managers, right? When you're doing an SIP, the fund manager is already doing the profit booking for you. You don't need to do incrementally anything also. You just have to handle your asset allocation to say that if I'm a balanced investor and suddenly my equity is looking 70 or 80% and not 50-50 that I initially intended to, can I skip my profit and rebalance? And similarly, if my equity is suddenly looking only 30 because the market has fallen, can I then invest more at that time? That bit of rebalancing and asset allocation in terms of action is enough as an investor, and then leave it to the experts and pay for that quality is what I'll say.
Okay, these are some real pearls of wisdom, but we have to take a short commercial break. You guys don't go anywhere. We'll be back with our special Future Female Forward segment in just a bit. Stay tuned. Welcome back to Smart Money. This is our special segment, Future Female Forward, where we're talking to a woman achiever who has been in the industry of finance for over 20 years and is trying to teach us some lessons so that, we can inculcate these habits and grow our corpus as well and achieve all our financial goals. Ayshwarya Desikan of HSBC is with us. Ayshwarya, you've really thrown some truth bombs at us, right? What one should be doing and not doing with your portfolio. Let's move to lesson number 4, which is be dispassionate about your investment. This is very hard. Trust me, because a lot of times your ego and your emotions come in the way. Oh, this stock has given me great returns. Now maybe I should hold on a little bit more and not cut my losses. But when you talk about being dispassionate, what do you mean?
So you hit the nail, right? I think as human beings, we are a bundle of emotions, and that does play a part in every decision that we take. Not very different in how we behave in the financial markets or what we take decisions on the stock. Now here, when I say dispassionate, two things, right? One, we need to understand where are we getting sentimental about something and take those calls. So basically, like, if assuming you bought a house and it served a purpose, it's your first investment, whatever, but there are times when you realize that that asset is no longer serving your purpose. The cost of maintenance is very high, considering the appreciation value that you might get from it. So evaluating the cost of holding that asset and evaluating the cost of letting go and the opportunity that is otherwise available also becomes very, very important. So that decision to let go is extremely essential. It might sound very philosophical, I guess, and we always battle with it.
No, it doesn't. It really resonates with me because there was a time a couple of years ago where I had two options, whether to buy a house or to invest in equities. And, because owning a house is sort of like, it gives you that little bit of power as well, that you own an asset. But eventually I realized that investing in equities is giving me far better returns. So I take your point. Go ahead.
The second one, I would say, honestly, Sonia, is also about the ego that comes in, right?
Yeah.
A lot of times, that is really what derails people's portfolios. You like a stock, you buy it, and then there is a correction. Now, it could be something which is just a market-driven correction, or a cyclical correction, or it could be something fundamentally wrong with that company or that particular investment class that you're invested into. That differentiation becomes extremely important. So you take a recent example of a bank stock which went up to 383. There were issues in the bank which was called out and it fell down to 150. The people who held it were still buying. It went to 50, you were still buying.
Are you talking about Yes Bank?
So there are people who are telling you that I'm averaging my buy, right?
Yeah.
I bought at 380, let me buy it at 150. I bought it even at 10 rupees.
Yeah.
So, now, what is the cost? How long is it going to take for it to bounce back? And
the opportunity
cost of what else you're losing out because of just feeding into this because you don't want to let go. I think that differentiation becomes critical, which ties into the earlier point that you were talking about, right? I think when you have a financial advisor, they are able to spotlight these blind spots for you.
Yeah.
If you don't have that, then, you are doing it all on your own.
And they are also able to cut the emotions out of the picture, right? Because it's not their house or it's not their asset or their stock that they're selling.
Absolutely. It's easier to manage other people's money than your own at any point in time for everyone,
It's like a doctor, right? I mean, it's easier to do surgery on a random person than on your own child. So I take your point. Okay. The next lesson and the fifth lesson, I want to spend a little bit of time here, is price versus quality. Now, this is important because, in today's stock market, it's become increasingly hard to find good prices. There's great quality businesses, but prices are not available. What do you do at a time like this?
So that's why I think understanding the basics in terms of some fundamental, is important. Second thing is the price is always about what is the value rather than the price. And if that valuation is reasonable for a future appreciation or a future potential in terms of what you're looking for, I think then it's a good price to buy. But if not, is when there is a problem. So it is not about something being expensive or not being expensive, right? If something has probably had a track record, even in mutual funds, people have this, right? That should I buy it at NFO because it's a 10 rupee NAV?
Yeah.
Should I buy it because it became 8, 9, it fell? Or should I buy it later, it has become expensive? That's not the point. If it has got a track record, if the fundamentals are right, if someone is really managing that asset class and you know that the future potential is very much in line, I think that is the decision that you take. But if that is not the case, and then you are looking at something and buying it just because someone else has made money, those are the ones which really become traps for you in the long run.
Okay. I had a couple of more questions before we wrap up the show, and I'm really sad to end the show because I'm learning so much from you. One thing that I've always, this debate I've always had is active versus passive, right? I mean, I'm a staunch believer of passive funds because I think that in passive funds, you're removing a lot of the biases, human, familiarity bias, all of that. But you tell me, from someone who's been in the market for maybe 25 years now, where have you got the best returns?
It's a combination.
Okay.
Because there are certain, especially when you look at a mid-cap or a small cap and all of that, right? There are those fund managers and asset management companies which really take research seriously. They really build fundamentally good portfolios, and the barometer for evaluating them is how they have done vis-a-vis the index itself.
So who are the fund managers lately?
So, I mean, there are quite a few of them. And in fact, in HSBC itself, right, we actually work with a set of approved fund houses and fund managers, which we are comfortable with. And we do a lot of internal research from the bank also to say that what is the track record? Is it return by chance, or is it something that is actually research backed? What is driving it? Now, everyone makes mistakes. You do go through those cycles. But predominantly, are you able to evaluate whether there is a system behind these emotions which is able to track it? And if that system is in place, and most of the fund houses have that today, then accordingly you are able to use that and see how it is kind of translating into the actual management of the portfolio, which is reflective on the returns of the portfolio, right? So it is a combination. There's no right question of one size fits all. But I guess, again, it is more about if you look at the track record and if you look at how it is spanned out, it will be very clearly visible of who is able to give you that alpha.
Okay, 2 quick questions before we wrap up the show. One is, what is your biggest investment advice to all the viewers or people who are watching you right now?
So first, I think what I have learned is just be systematic in your investment. I think that's the biggest advice that I have taken and I would like to leave people with. Do not try to accumulate cash flows and wait for that one big opportunity either ways. It is important to kind of not try and time the market, because no one has ever really made return consistently timing the market. A lot of times the sentiments are in the short term looking like big events. But if you look at a long-term chart, they are very, very small blips. And eventually, if the country is doing well and you are looking at the progress and you have seen the kind of returns that it has been multiplying, the fact that you're disciplined, you're systematic, will take care of a lot of things for yourself.
Okay, so be disciplined. And my final question, which is always on my mind, how do you manage or balance motherhood and work?
Sonia, it's a combination, right? One, if you're passionate about what you do, you will make time for it. It is not just about work in a corporate culture or anywhere else. It's the same thing with motherhood. All of us are passionate about our family. We will make that time. So it is about ensuring that that quality time is available, you prioritize properly, and you learn from your mistakes. It's not that you're always right. There are times when you go through those ups and downs, but you learn and you move on and really don't keep that hanging up and make you feel guilty.
Honestly, can you have it all?
I think you can. It's all in your mind. And I mean, at the end of the day, right, it is about how much guilt do you want to... sorry, can we do that?
Yeah, go ahead. So can you have it all?
I guess you can. It's easily said, but I have felt that I've always had it all.
Okay.
Touch wood for that. But I guess it is finally about...
How you manage your guilt.
How you manage your guilt. Very, very well done. Right? Because this is something that as women, we feel that you want to be the best in everything you do. And then you're always running after that guilt of not being that superwoman. I always feel we are human beings at the end of the day. Certain things could be good, certain things could be bad. It's perfectly okay. Your children understand, your family understands, people around you understand. We are hard on ourselves.
Yes. So don't be so hard on yourself.
Absolutely.
You cannot be everywhere all the time, right?
You need not be everywhere all the time.
You need not be everywhere all the time.
It's okay.
All right. On that note, thank you so much, Ayshwarya. It was a pleasure speaking to you, learning so much from you, and all the best. You've completed over 2 decades in your career, and I hope you have many, many more successful decades to go.
Thank you. Thank you so much, Sonia. It's wonderful being here, and thank you for having me.
Okay. And to all you viewers, thanks a lot for watching. Keep writing to us. We love receiving feedback from you. Have a great weekend.